This equity curve came from one of the simplest trading strategies you could possibly test. So there's no chart patterns, there's no machine learning, there's no complicated combination of indicators. It's just a classic RSI strategy that traders have been using for decades. Whenever I see strategies like this being promoted online, I always find myself asking the same question. Did anyone actually ever test every trade before presenting it to the people who may risk real money on it? So I manually tested approximately 10 years of RSI signals on the AUDCAD. Then I tested the same rules across 28 Forex currency pairs using almost 2 decades of daily historical data. I genuinely did not believe the result when I first saw it. Let's look at how the strategy was tested and what the results actually showed and what this attractive equity curve may still be hiding. First, the strategy. The RSI, or the Relative Strength Index, measures recent price momentum on a scale from 0 to 100. A reading below 30 is traditionally described as oversold. A reading above 70 is described as overbought. The basic idea is when price moves too far in one direction, it may eventually move back towards its recent average. So for a long trade, the RSI has to close at or below 30, and the trade is entered at the following day open. So it then remains open until the RSI returns back to 50, with the exit occurring at the next daily open. So for a short trade, it is exactly the opposite. The RSI closes at or above 70, and the short position is entered at the following daily open. The trade remains open until the RSI falls back to 50 and the exit occurs at the next daily open. That is the entire strategy. Because the rules are so simple, I genuinely expected the result to be underwhelming. But before trusting thousands of automated trades, I wanted to make sure that the strategy was being interpreted correctly. So I took the AUDCAD and manually worked through approximately the last 10 years of data. I simply started at the beginning of the period and recorded every qualifying RSI signal in order. Here is the first example. So the RSI closes below 30, that creates a long signal. The trade is then entered in the next day open. And I repeated that same process for every signal. The purpose of the manual test was not to prove that the strategy worked. It was just to verify that the entry rules and the exit rules and the percentage return calculations matched what was actually happening on the chart. So as each trade was added, the spreadsheet updated the compounded equity curve. And after approximately 31 trades, this was the result. Honestly, this looks great. It is not perfectly smooth and there are losing periods, but across this particular currency pair example, the equity curve moves in the right direction. And this is where it would be very easy to stop. But around 30 or 40 trades on one currency pair does not tell us whether we have found a genuine edge. The next question was much more important. Would the result survive a much larger test? I then applied the exact same rules across 28 Forex currency pairs. The test used daily data covering approximately 2005 to 2025. And every pair used the same RSI length and the same entry levels and the same exit rule. And this is the full equity curve. That is not an extraordinary result. It is not a holy grail. But for a strategy built around one indicator and a very simple set of rules, it was substantially better than I expected. Going into this test, my expectation was the RSI strategy would either lose money or just finish flat. But within this historical sample, the strategy showed evidence of a modest mean reversion effect. It does not mean every oversold market should be bought and every overbought market should be shorted. And it definitely does not mean this is ready to trade with real money. What it means is that under this exact rules, extreme daily RSI readings were followed by enough reversals to create a positive overall historical result. But there are several important things this result does not tell us. The first is what happened while the trades were still open. The final trade result only shows the entry and the exit. A trade can eventually close profitably after spending weeks deeply underwater, and that matters. The second issue is holding time. Some RSI trades can remain open for weeks or even months. That means financing and swap costs may become important. I chose not to invent one universal financing assumption because swap costs vary between currency pair, trade direction, broker, and interest rate environment. But excluding those costs may make a long holding strategy look better than what a real trader could actually capture. The third limitation is that this is still a historical backtest. It has not yet passed a walk forward test. It has not been deployed live. And it has not been tested under every possible execution condition. A positive backtest is evidence worth investigating. It is not a guarantee about what happens next. So does that classic RSI strategy work? Under these exact 30 and 70 rules across the daily, it performed better than I expected and produced a modest positive historical result. If there is one RSI filter or variation you think deserves testing, leave it in the comments below. I will add it to the next investigation and let the evidence decide.